Folks, there's a new 800-pound gorilla in the banking world after the Federal Reserve today approved U.S. Bancorp's acquisition of MUFG Union Bank's retail banking business. The green light for the deal gives U.S. Bancorp just under about $700 billion in assets and solidifies its status as the fifth largest retail bank in the country. Look at U.S. Bancorp, top of the S&P right now, up 3.7%. We've got Mitsubishi UFG Financial down about 1%. By the way, we've got the mixed bag of results today, as we already mentioned, from the likes of Wells, Citi, JP Morgan, Morgan Stanley. You've got everybody higher except Morgan, now down 5%. It's been a tough session for Morgan. All right, well, Wells, all of these names, if they beat, still, it was overshadowed by the fact that just about all of them saw profits fall year over year. With more financial titans on deck to release quarterly reports next week, let's break it all down with RBC Capital Markets large cap bank analyst and U.S. Bank Equity Strategy head of banks, Gerard Cassidy. Great to see you, Gerard. Which one of these four that came out today do you like the most, and what is the problem with Morgan as you see it?
Sure. Well, thank you for having me on the show. And I think one of the big trends that we saw with all four of the big banks, Citigroup, as well as JP Morgan Chase, we saw it with Wells Fargo and PNC and U.S. Bancorp. You didn't see it with Morgan Stanley. But the big story for the banks is the rise in short-term interest rates and the impact that's having on their net interest margins. These margins are growing very rapidly because the banks are able to reprice their assets faster than their funding costs. And it was quite striking at Wells Fargo because the mix of their deposits is geared to the consumer, whereas a Citigroup, on the other hand, has more wholesale deposits, so they didn't benefit as much on the margin expansion as somebody at Wells Fargo did. So what we have been recommending to investors is to look at the banks with a high concentration of consumer deposits, because the margin expansion for those banks will be better. And we saw that again at Wells. So in today's names, PNC is the name we'd recommend investors look at because of their high concentration of consumer deposits, but also commercial loans on the asset side of the balance sheet.
Well, I get that. And then I would think that a name like KeyBank looks pretty good if you're thinking with that logic as well.
Liz, right on. I would totally agree with you. For next week, when KeyCorp reports, very strong consumer deposits, one of the best of the regional banks, and they have one of the highest levels of commercial and industrial loans. And what we saw today from the banks was the C&I loans, as they're referred to. We saw double-digit loan growth on a year-over-year basis, in some cases over 20%. So we should expect to see KeyCorp put up very good C&I loan growth, and then they'll support that with core funding, which would help their net interest margin.
These rates are so high, and you mentioned that the margins are looking good for a lot of these banks, but it's almost as if whatever they capture from charging more from loans is being tinged a little bit in the red because people are worried we're seeing a slowdown in the economy and that high rates will slow down everything. That's the Fed's intention, actually. But Jamie Dimon's over at JP Morgan had said we're still on the path for an economic hurricane and a recession. How do you play those names knowing that that is the possibility?
You put your finger right on it. There are some real cross currents for the bank stocks. You have the strong benefit, of course, of these higher rates, but offsetting some of that benefit, of course, is the expectation that credit will deteriorate. And that was the interesting part about today's results. All of the banks reported very strong credit. The net charge-offs, which are credit losses, in most cases were down or flat. The actual delinquent loans or non-performing assets, as they're referred to, they were flat to down. So no one showed any evidence of deterioration. Now, what has happened, though, is the banks under the new accounting rules called CECL, Current Expected Credit Loss Accounting, which went into effect in early 2020, the banks have to now start building up these reserves for loan losses if we go into a recession next year. And we saw that today. But what it was more interesting was the growth in revenue more than offset the buildup of these reserves. But you're bringing up a good point. There's a real concern amongst investors that next year, if we see unemployment around 5 or 6% and negative GDP growth sometime next year, it's going to be more challenging on credit. That being said, though, the banks are going to still be able to maintain this revenue strength because we don't expect rates to be cut at all in next year by the Fed, and that will maintain those margins.
We are on deck for a lot of bank earnings next week. Gerard, thanks for setting us up ahead of that. We appreciate it.
You're very welcome. Thank you for having me on the show.
Anytime.